Is International Seaways ready to transform industry challenges into investor gains? We'll explore their strategic debt reduction, an unexpected surge in cash flow, and persuasive valuations that may indicate significant growth on the horizon. Learn how this maritime leader plans to weather market turbulence and potentially enhance your investment portfolio. Ready to set sail? Let's begin. International Seaways Inc. is a leading force in maritime oil transportation, operating a diverse fleet of vessels worldwide to serve major energy companies with essential shipping services. Despite their strong market position, the inherent cyclical nature of the shipping industry, which means demand and profitability fluctuate over time, presents risks that investors should carefully consider. Examining International Seaways' balance sheet reveals a steady reduction in their debt-to-equity ratio, decreasing from 0.43 at the end of 2023 to 0.35 by September 2024. The debt-to-equity ratio measures financial leverage, how much a company funds its operations through debt compared to equity. A lower ratio indicates less reliance on debt financing. This successful deleveraging enhances the company's financial stability. Although cash and equivalents decreased by $23.5 million, these funds were allocated to operational needs and capital expenditures, demonstrating prudent cash management. Retained earnings have grown significantly, reflecting profitable operations. Management's strategy of disposing of vessels to boost liquidity improved the net debt to capital ratio from 23.8% to 21%. By prioritizing debt reduction, the company strengthens its balance sheet, providing greater flexibility for future opportunities, an encouraging sign for value investors focused on financial health. Reviewing the full balance sheet, we can see that International Seaways' asset growth outpaces its liabilities, signaling strong financial positioning. This asset strength provides a cushion against potential fiscal challenges, appealing to value investors seeking long-term, stable opportunities amidst volatile market conditions. International Seaways' net income margin decreased from 56.2% in Q2 to 40.7% in Q3 2024. This decline is due to a $16.3 million fall in time charter equivalent revenues, a measure of average daily revenue performance, resulting from lower charter rates and increased off-hire days, which are periods when vessels aren't earning. Although the gross margin increased, it couldn't offset the revenue decline. Management cites mixed market conditions. Crude tankers are facing pricing pressure, while the MR and LR2 segments are performing better. They are optimistic about adjusting vessel strategies to meet market challenges and support growth. As investors, we must consider whether these adjustments will enhance profitability amid market volatility. In the full income statement, a key concern is the rising interest expense, which stands at $12.5 million and impacts profitability. It's crucial for International Seaways to manage this effectively. Compared to competitors, having a lower interest expense could bolster future profitability, making it a priority for sustainable growth. International Seaways has experienced a steady decline in revenue and net income over recent quarters, highlighting significant industry challenges. This downward trend stems from volatile oil supply and demand dynamics affecting charter rates, the prices for renting out their tankers. Lower charter rates lead to reduced income, impacting profitability. In response, management is optimizing fleet utilization, maximizing the operational efficiency of their ships, and pursuing asset management opportunities to boost earnings. For investors, assessing how these strategic measures compare to those of competitors is crucial in evaluating the company's potential in the current market conditions. International Seaways' cash flow statement shows significant improvement in Q3 2024, with free cash flow rising to $115.3 million from a negative $8.6 million in Q2. This turnaround is due to strategic asset sales and disciplined capital spending, reflected in a capital expenditure margin of 15.0%. The free cash flow yield improved to a healthy 7.0%, indicating efficient cash generation relative to the company's value. Despite higher operational costs, management is enhancing liquidity to support fleet renewal and growth initiatives. This focus on strategic capital allocation and cost control suggests sustainable financial health, which is promising from a value investor's perspective. Reviewing the full cash flow statement, we note that cash from operating activities shows resilience, with $453.5 million generated. However, high expenditures of $216.6 million on vessels highlight significant reinvestment risk. A stable cash balance of $103.5 million indicates solid liquidity, crucial for ongoing fleet enhancements and strategic expansions. Analysts forecast project that International Seaways will achieve a net income of $370 million and an earnings per share of $7.60 by 2027. This steady outlook reflects strong financial fundamentals and management's confidence in the company's underlying value. However, it's important to consider external factors like global economic conditions and industry competition, which could affect these projections. Management's commitment to strategic initiatives aimed at enhancing shareholder value is a positive sign, but potential market volatility should not be overlooked. For value investors, assessing whether these earnings forecasts align with the company's current valuation is crucial in determining its investment potential. During the recent earnings call, International Seaways reported strong financial results driven by increased demand in the tanker market and higher charter rates. Management highlighted high fleet utilization and effective cost controls that boosted profitability. They emphasized the success of their fleet renewal program, noting that newer vessels enhance fuel efficiency and comply with environmental regulations. While acknowledging market volatility and geopolitical risks, the company pointed to their diversified customer base and long-term contracts as stabilizing factors. Compared to peers, International Seaways maintains a solid balance sheet with manageable debt, offering flexibility for future investments. These factors suggest a strengthening financial position, but investors should be mindful of the shipping industry's cyclical nature when evaluating long-term value. International Seaways shows a competitive edge when we compare key valuation metrics. Its price-to-earnings ratio of 4.0 and price-to-book ratio of 1.3 are on par with or better than several industry peers. A lower price-to-earnings ratio can indicate that the company's stock is undervalued relative to its earnings, which may attract value investors. A price-to-book ratio close to 1 suggests the market price aligns closely with the company's book value, reflecting potential fair valuation. Management's confidence in the company's intrinsic value is evident, supported by a solid financial foundation and strategic asset management. However, it's important to consider external economic headwinds and industry challenges that could impact future performance. The discounted cash flow valuation of International Seaways reveals considerable potential. The base scenario projects a share value of $147.60 by 2028, with optimistic forecasts reaching $177.10 and a pessimistic view at $118.10. These figures highlight the company's strong growth prospects and solid financial footing. However, the wide range among scenarios indicates sensitivity to market and economic uncertainties. It's crucial to consider these factors when assessing the investment's value. Management's focus on capitalizing on growth opportunities while mitigating risks could be pivotal. Understanding how discounted cash flow reflects future cash flows helps investors gauge intrinsic value beyond current market prices. International Seaways has a projected 12-month price target of $56, indicating potential appreciation despite recent stock volatility. The closing price of $49.80 in September 2023 reflects market fluctuations, yet management remains cautiously optimistic. They plan to leverage anticipated growth in global oil consumption and make strategic fleet deployments, optimizing vessel utilization to enhance efficiency. Acknowledging economic uncertainties and dynamic market conditions, the company focuses on tactical adjustments to strengthen competitiveness and maximize shareholder returns. Evaluating these strategies is essential for understanding the company's prospects as a value investment. International Seaways demonstrates solid financial health, with asset growth outpacing liabilities and a successful reduction in the debt-to-equity ratio enhancing stability. Their prudent cash management and strategic fleet optimization address industry cyclicality directly. Despite a recent drop in net income margin due to market pressures, management's initiatives in cost control and asset sales have significantly improved free cash flow. Competitive valuation metrics, like a price-to-earnings ratio of 4.0, suggest potential undervaluation. While challenges like rising interest expenses and market volatility persist, the company's strategic focus and financial resilience position it as a compelling opportunity for value investors seeking long-term growth. Be sure to watch another video from our Value Explorer series by clicking the playlist below.